You probably didn't plan to be here, sitting with this question at this point in your life. But here you are. And somewhere between the job, the mortgage, the kids' tuition, and the years that moved faster than anyone warned you, something shifted quietly inside you. A realization you haven't said out loud to many people. The money you saved might not be enough. Not because you were reckless, not because you didn't try, but because nobody ever sat down with you and explained how money is supposed to keep working after you stop. That's what we're here to talk about today. Not schemes, not hype, not some list you've already seen a dozen times. This is the real conversation. The one about building income that flows whether you're working, sleeping, or finally taking that trip you keep postponing. Passive income. The kind that builds retirement wealth, not overnight, not magically, but steadily, quietly, the way real things grow. Stay with me. Let's start with something honest. Most people think passive income means doing nothing. And that's exactly why most people never build it. The word passive is misleading. It makes you picture someone on a beach, checking their phone while money appears. That image is real for some people, but only after years of very active decisions. What's passive now was intentional then. Think of it like a river. You don't stumble onto a river. Someone, at some point, dug the channel, moved the earth, redirected the flow, and then, only then, the water started moving on its own. That's what passive income actually is. You do the digging first. The flowing comes later. And here's what makes this conversation different for you. For someone at 40, 50, maybe 60. The channel doesn't have to be enormous. It just has to be real. And pointed in the right direction. There are people right now, people your age, who started late and still built something that changed their retirement completely. Not because they found a secret, because they stopped waiting for the perfect moment and started understanding the mechanics. So let's talk mechanics. The first thing you need to understand is that there are essentially two kinds of passive income streams. The kind that requires capital, money working for money, and the kind that requires time upfront, knowledge, systems, content, or assets you build once and monetize repeatedly. Most people in their 40s and beyond have more of the first than they realize. A 401k, a brokerage account they haven't touched in years, equity in a home. These are seeds. They just haven't been planted correctly. The second kind, time-based passive income, is more misunderstood. People assume it means starting a YouTube channel or writing a book. And yes, those are options. But they're not the only ones. And for most people listening right now, they're probably not the right starting point. What matters is matching the right income stream to where you actually are, your capital, your time, your risk tolerance, and your timeline to retirement. Because here's the thing nobody talks about enough. Passive income built 10 years before retirement looks completely different from passive income built 2 years before retirement. The strategy changes, the urgency changes, the tools change. And if you've been treating them the same way, you may have been optimizing for the wrong thing. We're going to fix that today. One stream at a time. One decision at a time. Starting with the one that, for most people in your situation, makes the most sense to build first. Let's talk about the one passive income stream most financial advisors mention first, and most people misunderstand completely. Dividend investing. You've heard the word. Maybe you've even bought a few shares of something that pays dividends. But there's a difference between owning a stock that pays dividends and actually building a dividend income stream. That difference is what separates people who feel good about their portfolio from people who actually live off it. Here's how most people approach it. They find a stock with a high yield, they buy some shares, they watch the quarterly deposit hit their account, and they feel like they've cracked the code. Until the company cuts the dividend. Or the stock drops 30%, And the yield that looked so attractive was actually a warning sign nobody explained to them. So let's go deeper. A dividend is a portion of a company's profit paid directly to shareholders. When a company earns more than it needs to reinvest in itself, it returns that money to the people who own it. That's you, if you hold the stock. The power isn't in the individual payment. The power is in the compounding. Imagine you own shares that pay you $200 a month. You don't spend that $200. You buy more shares? Those shares pay you more dividends next quarter. You buy more shares again. Over years, that cycle becomes something that looks almost mathematical in its elegance. The income grows not because you added more money, but because the system started feeding itself. Warren Buffett has collected over $700 million in annual dividends from Coca-Cola alone, from shares he bought in 1988. He didn't touch the principal. He just let time do the work. But here's the part people skip over. Not all dividends are equal. A 9% yield sounds better than a 3% yield. But if that 9% company is paying out more than it earns, if the payout ratio is unsustainable, that dividend will get cut. And when dividends get cut, the stock price usually falls at the same time. You lose twice. What you want are dividend growers, companies that have raised their dividend consistently for 10, 20, 25 years in a row. There's even a name for the elite group, dividend aristocrats. These are S&P 500 companies that have increased their dividend every single year for at least 25 consecutive years. Think about what that means. Through recessions, through market crashes, through wars and pandemics and interest rate cycles, these companies kept paying more. That's not luck. That's the sign of a business with pricing power, discipline management, and a genuine commitment to shareholders. For someone building retirement wealth right now, a portfolio anchored in dividend growers, combined with a few well-chosen dividend ETFs for diversification, is one of the most reliable passive income foundations you can build. It won't make you rich overnight. But 10 years from now, if you start today, you might look at your quarterly statements and feel something you haven't felt in a while about money. Calm. Now let's talk about real estate. Because almost everyone in this conversation has thought about it. A rental property, passive income from a tenant, the idea of someone else paying your mortgage while you build equity. It's appealing, and it can absolutely work. But let me be direct with you about something first. Owning a rental property is not passive income. Not really. Not in the beginning, and often not ever. There are tenants who don't pay. Roofs that need replacing. Property managers who take 10% and still call you on a Saturday. There are vacancy months and maintenance costs and tax filings that make April feel like a small punishment. None of that means it's a bad investment. It means it's an active one, dressed in passive clothing. For some people, that trade-off is worth it. The returns can be strong. The leverage is real. You can control a $400,000 asset with $80,000 down. And over time, a paid-off rental property producing $1,800 a month is a genuinely powerful thing. But for others, people who don't want to be landlords, people who don't have the capital for a down payment, people who want real estate exposure without the phone calls, there's a better path. REITs, Real Estate Investment Trusts. Companies that own income-producing real estate, apartment buildings, office towers, shopping centers, hospitals, data centers, cell towers, and are legally required to distribute at least 90% of their taxable income to shareholders. You buy shares like a stock. You collect income like a landlord. You never fix a single leaky faucet. Now, REITs aren't perfect. They're sensitive to interest rates. When rates rise, REIT prices often fall because their borrowing costs increase and their yields become less attractive compared to bonds. If you bought REITs in 2021 and held through 2022, you felt that. But zoom out further. Over long periods, REITs have historically delivered total returns, income plus price appreciation, competitive with the broader stock market. And the income component alone, for someone in or near retirement, can be significant. There are different categories worth understanding. Equity REITs own physical properties. Mortgage REITs lend money to property owners and earn interest, higher yield, higher risk. And REIT ETFs give you a diversified basket of both, spreading your exposure across hundreds of properties and dozens of property types. For most people building retirement income, a REIT ETF as one layer of a broader strategy makes more sense than picking individual REITs. The diversification protects you from what happens when a single sector, say office real estate, goes through a structural crisis. And we've watched that happen in real time. Here's the larger point I want you to hold on to as we go through each of these income streams. No single stream is the answer. The goal isn't to find the one perfect source of passive income and pour everything into it. The goal is to build multiple streams that complement each other, that don't all rise and fall together. Dividends from stocks, income from real estate, interest from bonds, returns from something you built with your own knowledge. When one stream slows, and at some point, one always does, the others keep flowing. That's not a theory. That's what financial resilience actually looks like in practice. Not a single pipe, a system of channels. And we're building yours, one block at a time. There's a category of passive income that doesn't get talked about the way it should. Not because it's complicated, because it's quiet. Bonds, fixed income, the part of a portfolio that most people under 50 ignore, and most people over 55 wish they had understood sooner. Let me tell you what a bond actually is, stripped of all the financial jargon. When a company or a government needs to borrow money, they don't always go to a bank. Sometimes they go to you. They issue a bond, essentially a formal promise that says, lend us money today, and we'll pay you interest on a fixed schedule and return your full principal at the end of the term. You become the lender. They become the borrower. And every 6 months, they send you a check. That's it. Now, why does this matter for passive income? Because bonds do something that stocks don't. They pay you on a schedule you can predict. When you own a 10-year Treasury bond at 4.5%, you know exactly what's coming in. Twice a year. Every year for a decade. There's no board of directors deciding whether to raise or cut the payment. The terms are locked in the day you buy. For someone building retirement income, that predictability is worth something real. Think about the difference between owning a rental property where the tenant might leave next month and owning a bond where the U.S. government has contractually committed to paying you 4.5% annually for the next 10 years. One keeps you up at night. The other doesn't. But here's where people make the mistake. They wait. They spend their 40s and early 50s treating bonds like something their parents held. Boring, low return, irrelevant. And then they arrive at 62 with a portfolio that's 95% stocks and no income floor. The market drops 30% the year they retire, and suddenly the entire plan has to be rebuilt from scratch. There's a concept called sequence of returns risk. It sounds technical, but the idea is simple. If your portfolio drops sharply in the first few years of retirement, right when you start making withdrawals, the damage is permanent in a way that a drop in your 40s simply isn't. Because in your 40s, you're still adding money. In retirement, you're taking it out. The math works against you in a completely different way. Bonds, specifically a ladder of bonds with staggered maturity dates, can protect you from that risk. You hold bonds that mature in year 1, year 2, year 3 of retirement. Each maturity gives you cash to live on without selling a single stock, no matter what the market is doing. That's not conservative investing. That's intelligent architecture. Now, the bond market has changed. Interest rates rose sharply from 2022 onward, which was painful for people who held existing bonds, but created a genuine opportunity for people buying new ones. Yields that hadn't been available for over a decade came back. Treasury bonds, I-bonds, municipal bonds, which carry tax advantages worth understanding, corporate bonds from investment-grade companies, each with its own risk and return profile. And again, for those who want exposure without the complexity of building a bond ladder themselves, bond ETFs provide immediate diversification across hundreds of issuers, with daily liquidity and low expense ratios. The income won't make headlines. It won't be a story you tell at dinner. But 5 years from now, when the market goes through something ugly, and it will, it always does, you'll feel the difference between having that floor and not having it. Quiet income, steady income, the kind that lets you sleep. We've talked about dividends, real estate, bonds, each one a real stream, each one worth building. But there's something underneath all of them that most people never stop to examine. A question that sounds simple but changes everything once you answer it honestly. Are you investing for growth or for income? Because those are not the same thing. And confusing them is one of the most common and costly mistakes people make in the decade before retirement. Let me explain. When you're 35, investing for growth makes perfect sense. You buy index funds, you reinvest everything, you don't touch it. You let compound interest do its work over 25 or 30 years. You don't need the money now. You need the number to be bigger later. But at 50, something needs to shift. Not dramatically, not all at once, but directionally. Because at 50, later is no longer abstract. Later has a specific shape now. It has a year attached to it. And the strategy that builds wealth is not always the same strategy that converts wealth into income you can actually live on. This is where index funds, specifically total market and S&P 500 index funds, play a role that's more nuanced than people realize. An S&P 500 index fund doesn't feel like a passive income vehicle. It doesn't pay a dramatic yield. The dividend yield on something like VOO, the Vanguard S&P 500 ETF, sits around 1.3% to 1.5% in most years. That's not going to replace a paycheck. But here's what people miss. Total return is not just yield. Total return is yield plus price appreciation. And when you're in retirement, you have a choice about how to access that return. You can collect dividends, or you can sell a small percentage of shares each year, what's called a systematic withdrawal, and create your own income stream from the growth itself. The 4% rule, one of the most studied frameworks in retirement planning, is built on this idea. Research from financial planners going back to the 1990s showed that a retiree who withdrew 4% of their portfolio in year one, then adjusted for inflation each year after, had a historically high probability of their money lasting 30 years, even through major market downturns. That's not a guarantee. No rule is. But it's a framework built on decades of real market data, not optimism. What it tells you is this: a $500,000 portfolio, managed correctly, can generate $20,000 a year in sustainable income. $1 million generates $40,000, not from magic, from structure. And structure is what we've been building this entire conversation. Dividends as your base layer. REITs for real estate income without the headaches. Bonds as your floor. Predictable, scheduled, protected. Index funds as your long-term growth engine, gradually converting to income as retirement approaches. None of these streams alone is the answer. All of them together, weighted correctly for your age, your risk tolerance, and your timeline, become something different from any individual piece. They become a system. And systems do what individual decisions can't. They work when you're not watching. They compensate when one part underperforms. They keep flowing even when markets panic, even when headlines are frightening, even when everyone around you is making decisions from fear. You've probably made some decisions from fear in the past. Most people have. It's not a character flaw. It's what happens when you don't have a system and the market moves against you. But that's exactly what we're building here, one layer at a time. Before we go further, I want to pause for just a moment. If you've made it this far with me, I want to invite you to subscribe to our channel and follow along every day. Because what we do here isn't noise. It's not hype. It's not hot takes, and it's not advice designed to sell you something. It's the conversation that most people in their 40s and 50s never had with anyone. About money, about time, about what it actually takes to build a retirement you don't have to fear. If this has been useful to you today, subscribing costs you nothing, and it means you won't miss what's coming next. Now, back to what matters. We've built the foundation: dividends, real estate through REITs, bonds as your income floor, index funds as your long-term engine. But there's one more stream I haven't mentioned yet. And for some of you, it might be the most powerful one of all: the income you can build from what you already know. Stay with me here, because this is where most financial content stops, and where the real opportunity begins for people at your stage of life. By the time you're in your 40s or 50s, you have accumulated something that took decades to develop: skills, experience, hard-won knowledge about an industry, a craft, a process, a problem. Things that feel ordinary to you because you've lived with them so long, but that other people would pay to understand. That knowledge can generate income, real, recurring, passive income. Not through becoming a social media personality, not through building a massive audience, but through packaging what you know in a form that works while you sleep. An online course, a digital guide, a template, a subscription newsletter serving a niche you understand better than most people on Earth. These are assets. The same way a bond is an asset. The same way a rental property is an asset. You build them once. They produce returns over time. The difference is the capital required. A rental property might need $80,000 down. A digital product built on your expertise might cost you a weekend and $200 in software. Now, I'm not telling you this is easy. Building something from knowledge takes focus. It takes honesty about what you actually know versus what you think you know. And it takes patience, because unlike a dividend stock that starts paying you in 90 days, a digital product takes time to find its audience. But here's what makes it worth considering. This kind of income doesn't correlate with the stock market. When the S&P 500 falls 20%, your online course doesn't fall with it. When interest rates rise and REIT prices drop, your digital product keeps selling. It's a stream that moves independently of everything else we've discussed. And for someone building a multi-stream retirement income system, which is exactly what we've been doing today, an uncorrelated stream is extraordinarily valuable. Think about the architecture we've built together across this conversation. Market-based income from dividends and index funds, real estate income from REITs, fixed income from bonds, and knowledge-based income from something you built yourself. 4 streams, 4 different sources, 4 different rhythms. When markets fall, bonds hold. When rates rise, knowledge income keeps flowing. When one company cuts its dividend, the others keep paying. No single event, no crash, no recession, no rate cycle can shut all 4 streams down at the same time. That's not wealth. That's something more durable than wealth. That's freedom with a foundation underneath it. Here's what I want to leave you with. Not a formula, not a checklist. Something quieter than that. Most people spend the first half of their lives trading time for money. They show up, they produce, they collect a paycheck, and somewhere in that exchange, they assume the second half of the equation will take care of itself. It doesn't. Not automatically. Not without intention. But here's what I've watched happen. With people who sat exactly where you're sitting, asking exactly the questions you're asking, when they stopped waiting and started building. The change isn't loud. It doesn't happen in a single moment. There's no dramatic before and after. What happens is quieter than that. One dividend deposit, then another. A bond that matures exactly when you needed the cash. A REIT that kept paying through a downturn you were certain would break everything. A small digital product that sold 17 copies while you were on vacation. Individually, none of it feels like enough. Together, it becomes something you stop worrying about. And that, the absence of that particular fear, turns out to be worth more than any specific number in any specific account. Because it's not just financial, it's the way you wake up in the morning, the way you look at the next 10 years, the way retirement stops feeling like a cliff at the edge of a road and starts feeling like a door you chose to walk through. You built that. Not luck, not timing, not a windfall, a system, patient, layered, intentional. That's what this channel exists for. Not to make you rich in 30 days, not to sell you a course or a fund or a philosophy, to give you the kind of clarity that makes the next decision easier than the last one. And the one after that, easier still. If today was useful, if something landed, if something shifted, even slightly, I'd ask you to do one thing. Share this with 5 people you care about, not strangers. People in your life who are asking the same quiet questions you've been asking. Because this conversation doesn't get smaller when you share it. It gets more useful. Subscribe to the channel if you haven't already. We're building something here, one video at a time, and the next conversation is already coming. And before you go, leave a comment below. Tell me honestly, which of these income streams is the one you want to understand better? Dividends? REITs? Bonds? The knowledge-based path? Tell me what you need next. I'll build it for you. Because the best thing about a system is this: it's never finished. It just keeps getting stronger.